It is in the field of economics that the impact of globalization can most clearly and unambiguously be seen. And indeed, when many people use the word globalization, they use it as a synonym for neoliberalism, the dominant free market economic paradigm of the last 40 or so years. Of course, global economic integration is nothing new. A quotation from the 1930s describing the effects of the Great Depression, when America sneezes, the rest of the world catches a cold, highlights this. But as noted in the previous lesson, it is the unparalleled depth and closeness of the integration which is different in the contemporary world. This said, there is evidence that since the 2008 global economic crisis, the world has experienced a period of deglobalization, and in fact, global economies are moving away from closer integration. This lesson will firstly look at what is meant by economic globalization and some of its key features, before giving some information about the key types of organisations which are both the cause and the result of economic globalization. At the end of the lesson, the advantages and disadvantages of economic globalization will be presented. To understand some of the key features of economic globalization, we will be examining 5 of its key aspects. Number 1, reduction of barriers to trade. Free trade is if not the, central tenet of economic globalization. It is believed that increasing free trade will lead to higher employment, more competition, and, as a consequence, a lower price for goods. Free trade is considered to be the engine of growth. As outlined in the first lesson, between 1955 and 2005, global trade grew by 10,000%. This said, however, even countries which can be considered evangelists of free trade, such as the US and China, have been accused of adopting hypocritical protectionist methods. Number 2, increase in foreign direct investment. Foreign direct investment, FDI, is investment made by a company or entity based in one country into a company or entity based in another country. Global FDI has increased hugely as a result of globalization. On the plus side, this has seen great capital flows and investment in parts of the world which otherwise may not have received it. On the downside, this only really works during periods of economic stability and growth. When there is an economic downturn, for example, as in 2008, problems arising in one part of the world, in this case the subprime mortgage crisis in the US, can quickly spread contagion globally. Number 3, multilateral firms becoming more common. A multilateral corporation is one which has facilities and other assets in at least one country other than its home country. The majority of large multinational companies are either from the USA, Japan, or Western Europe, for example Walmart, Honda, or BMW. The average revenue of many of these companies is higher than the GDP of nation states. If Walmart were a country, its $485 billion annual income would make it the 28th largest economy in the world, sitting between Norway and Austria. According to research done by the Swiss Federal Institute of Technology in Zurich, so influential and powerful are multilateral corporations that just 147 of them control 40% of the global economy, and 737 of them control 80%. Number 4, the internationalization of production. The deindustrialization of the West, through the relocation of much primary manufacturing to more cost-effective parts of the world, has enabled the rapid growth of many economies, most notably China. To use economic language, globalization has enabled multinational corporations to be better able to apply comparative advantage strategies globally. Critics have pointed to the fact that these strategies are, in a sense, a form of neocolonialism, and the rise of sweatshops is a charge that has been levelled at many large MNCs, such as Nike and Apple in particular. And number 5, the ease of transactions and reduction in transaction costs. Individuals and companies can move money around the world in the modern world in a way that was unthinkable even just a few years ago. This has significantly reduced the cost of doing business and sped up capital flows worldwide. These reduced costs mean increased efficiency and effectiveness. However, one downside of this combined with the increased multinational nature of large companies, is that they are able to minimise their tax liabilities through a variety of means. The clear use of tax havens, such as the Bahamas or the Cayman Islands, which for many straddles the line between tax avoidance and tax evasion, means that many large MNCs pay, relatively speaking, very little tax. For example, in 2015, Amazon UK paid just £12 million in tax on a total of £5.3 billion worth of purchases made by British shoppers. The reason for this anomaly is that it is actually Amazon Luxembourg which sells to the UK, not Amazon UK, which just provides professional services. And Luxembourg has very favourable corporate tax rates. The third part will look at organisations. At this juncture, it is worth noting the influence and importance of the so-called Bretton Woods institutions in economic globalisation. Together, these institutions, the World Trade Organization, WTO, the International Monetary Foundation, at this juncture, it is worth noting the influence and importance of the so-called Bretton Woods institutions in economic globalization. Together, these institutions, the World Trade Organization, WTO, the International Monetary Federation, the IMF, and the World Bank, have a significant impact on national economies and international business. Whether or not this impact is desirable is another bone of contention. The criticism generally levelled at all three organisations is that they are attempting to implement a neoliberal economic agenda on countries which do not necessarily desire it. The World Trade Organization deals with the rules of trade between nations. At its core are the WTO agreements, negotiated and signed by the bulk of the world's trading nations and ratified in their parliaments. These are essentially contracts which bind governments to specific policies. Its main goal is to help producers of goods and services, exporters and importers conduct their business. The overriding goal of the WTO is to open markets and enable trade to flow as freely as possible, so long as there are no undesirable side effects. The overarching goal of the IMF is to observe and oversee global economic trends and to provide advice, support and guidance on macroeconomic issues. Specifically, they assist low and middle income countries in managing their economies and provide financial support to help countries avoid a balance of payment deficit and, therefore, potential bankruptcy. Thirdly, the World Bank, which is the largest public development institution in the world. In 2015, it had $157 billion of outstanding loans. Its main focus is on reducing poverty and creating sustainable growth in the world's poorest countries, specifically those in Africa, as well as post-conflict countries and fragile states. The World Bank focuses on funding projects, for example, building schools and hospitals, or in providing water and electricity. As their name suggests, they also have a global remit and concentrate their efforts on cross-border issues such as trade, climate change, and infectious diseases. In conclusion, it is likely that your views concerning economic globalization will be coloured by your economic views and beliefs. It is undeniable that the closer integration of economies has led to increased global wealth and the bringing out of poverty of millions of people. However, this has taken place largely in China and India, Chindia as it's sometimes known, and there are many parts of the world, most notably sub-Saharan Africa, which have not felt these benefits. One major criticism is that the economic growth created by globalization is not widely distributed, but remains within the pockets of a global elite.